Hello, good evening. Please confirm you can hear me clearly.
We can hear you, sir.
All right. Tonight, we shall continue with our discussion on bond valuation. A quick recap of our last class. At the last class, we look at question on bond valuation. Precisely, we look at, please, can we mute? Chidima. No, sir, please, can you mute? We look at question Kazaure Limited, where we are required to value two bonds. Now, if you look at that question, examiner was texting redeemable bond. At the last class, we explained that there are three factors to watch out, or three things you need to pay attention to if you are required to value a bond. Three things you need to pay attention to. What are these factors? One is the type of the bond. If you are required to value a bond, you are going to ask yourself, what is the type of the bond I'm required to value? Remember, we have like three types. You can have redeemable bond, irredeemable bond, or convertible bond. You may be required to value redeemable bond, a bond with a specific repayment date. Or you may be required to value irredeemable bond, a bond without a specific maturity date. Or you may be required to value convertible bond. So you are going to ask yourself, what is the type of the bond I'm required to value? Then number two factor to be considered is, who is the issuer? The issuer of the bond. Please remember, a bond may be issued by governments or by corporate company. A bond may be issued by the government or by a corporate company. If the bond is issued by the government, then you are going to value the bond using government rates. Government rate is represented by government sports.
Down on aggregate, but
Government sports yield curve. So if you are required to value a bond issued by the government, then you are going to use government sports yield curve as the discount rate for the valuation of the bond. Number 3 factors to be considered. Now, before we go to number 3, if the bond is issued by a corporate company, if the bond is issued by a corporate company, then you are going to use corporate company rates, corporate company yield curve as the discount rate for the valuation of the bond. Number 3 factor, the type of the rates. Remember, you have 3 types of interest rates, coupon rates. You can have fixed coupon rates or floating coupon rates, or you are having a 0 coupon bond. These are the 3 factors to be considered when required to value bond. At our last class, the question we solved was on redeemable bond. Tonight, I want us to look at question on convertible bond. How do we value convertible bond? To do this, we shall be looking at question number 2 in our study pack, Bobby Brown PSC. That should be page. Please go to the study pack. I'm not sure of the page. Just 1 minute. I think page 133. Illustration 2. Please refer to the study pack. Page 133. Illustration 2. We can reconfirm this question, Bobby Brown PSC. Are we there, please? Please, somebody confirm that we have opened the question, then we can proceed with the class.
Yes, sir.
Can somebody confirm this, please?
Please, what do you want us to confirm?
That you have opened the page Illustration 2.
Yes.
Yes, it's on page 131.
Okay, 131.
131 of that the pack you shared with us.
Of the soft copy material.
Yes, that's correct.
All right, thank you. Page 131. Page 131. Question 2. All right. We can proceed now. Let's go to the question together. Bobby Brown PSC has issued 10% convertible loan stock, which is due for redemption in 10 years' time, i.e., 31st December 2025. The option to convert is open only for another 2 years. If the conversion does not take place by December 31st, 2017, the option will lapse. The issue was sold to the public at a price of $920 for 1,000 naira of convertible loan stock. The conversion rate at January 1st, 2016 was 250 equity shares for 1,000 naira of stock. A non-convertible loan stock in a similar risk class is presently yielding 12%. The market price of Bobby Brown PSC shares has been increasing steadily over time, reflecting the performance of the company. The share price currently pays a dividend of 0.3 per share. The current share price of the convertible loan stock, the current price of the convertible security is 960. And each share is currently valued at 3 naira. A holder of the convertible loan stock is considering whether to sell the holdings or continue to hold the stock, ignoring taxation while answering the question. Requirements A. What is the value of the security as a simple, unconvertible loan stock? Requirement B. Okay, let's deal with requirement A. What is the value of the security as simple, unconvertible loan stock? Now, if you look at this question, it's about a convertible loan stock. What is convertible loan stock? Convertible loan stock are debt instruments that give the debt holder the rights, but not the obligation, to be converted to ordinary shares. I'll repeat that. Convertible loan stock. These are debt instruments that give the debt holder the rights, but not the obligation, to be converted to equity shares within a specified period. Now, the next question is, how do we value convertible loan stock? If you recall, we said there are two alternatives. There are two alternative approaches when valuing convertible bond. Alternative one is the valuation as a straight debt. There are two alternative approaches to valuing convertible bond. Alternative one is valuation as a straight debt. This alternative assumes that the convertible bond or the convertible loan stock will not be converted to ordinary shares. In this case, you are going to value it as an unconvertible debt. To do this valuation, you are going to determine the cash flows from the convertible bond from year one to maturity. Then you are going to discount this cash flow to their present value using required return on unconvertible debt. That is alternative one. If you look at requirements A, examiner says, what is the value of the security as simple unconvertible loan stock? What requirement one is texting is the valuation as a straight debt. What requirement A is texting you is to calculate the value of the convertible loan stock on the assumption that the convertible loan stock will not be converted to ordinary shares. All right, we have tried to explain this. Let's go to valuation. Any question, please? All right, let's go to the suggested solution. We move to the suggested solution page. All right, let's pick our pen. All right. Please, if your speaker is on, please help us mute. Except you want to ask a question. So we come here. Suggested solution. Requirement A. Value of the security as simple, unconvertible loan stock. In this case, you are going to determine the expected cash flows. The expected cash flows from the security. We have the convertible loan stock. Let us itemize the features. Maturity of the convertible loan stock. Examiner says 10 years. The face value of the loan stock. Examiner says 1,000 naira. The coupon rate. Examiner says 10%. Please, you can refer to the question. Look at it, please. Bobby Brown PSC has issued 10% convertible loan stock, which is due for redemption in 10 years' time. The coupon rate is 10%. Maturity is 10 years. The face value, look at it, 1,000 naira. Then the redemption value of the bond. Redemption value. Now this question is silent about the redemption value. The question is silent about the redemption value. If the question is silent about the redemption value, then we are going to assume that the bond will be redeemed at par value. The par value is the face value. We have itemized the features of this bond. Why am I doing this itemization? Is to enhance understanding. Next is to determine the expected cash flows from the bond. Our working one. Expected future cash flows. You start with annual interest. Annual interest is equal to the coupon rate 10% of the face value, 1,000 naira. That will give us 100 naira. This bond is for 10 years. So the annual interest will be from year 1 to year 10. We are going to receive interest in year 1, interest in year 2, interest in year 3, up to year 10. Then in year 10, we are going to get the redemption value at maturity. Redemption value at maturity. This is equal to 1,000 naira. That will be year 10. You have gotten the expected future cash flows of the convertible loan stock. We now need to discount this cash flow to their present value. We need to discount these cash flows to their present value. Now the question is, which discount rates are we going to use? We have gotten the cash flow. The next order is to identify the discount rates we are going to use to discount these cash flows. Let us go back to the question. Examiner give us a rate. Now look at paragraph 2. The second paragraph of the question. Examiner says the conversion rates
Similar class of risk.
January 2016 was 250 equity shares for 1,000 naira of loan stock. Full stop. Non-convertible loan stock in a similar risk class is presently yielding 12%. That means the rates, the discount rates for a non-convertible loan stock is presently 12%. That is the rate that will be used to discount this cash flow. Examiner will always give you this rate when you are dealing with convertible bond. So we can come here. Value of the convertible bond. Value of the convertible bond or convertible loan stock is, open your schedule, you have your year, you have your item, you have the cash flow, you have the discount factor, then you have the present value. You come here, year 1 to year 10, we have the annual interest, which is 100 naira. Year 10 only, we have the redemption value, which is 1,000 naira. Our discount rate is 12%. Now, please compute. Annuity factor year 1 to 10 at the rate of 12%.
It's 0.33.
I can't hear you, sir.
8.333.
6 points.
333.
6.3. 6.3. It is correct.
No, not 6.3. 5.65.
I was wondering.
5.65.
5.65. All right. I need to take this off. $5.65. Then 12% discount factor for year 10. 0.
0.322.
322. Now let's get the present value. This will give us 56.5. Oh, no. This will give us 565, and this will give us 322. Now, please sum up. This should be 887. This is the value of the convertible loan stock as a straight debt. This will give you your 5 marks. We are done with requirements A. We are done with requirements A. Any question, please? Yes, Suzanne, your speaker is off. Any question?
No, sir, sorry. I log out and log in. That's why. Sorry, sir.
All right, if there's no question, let us move to requirement B. Oh, why are you moving so fast? Look at requirement B. Examiner says, what is the expected minimum annual rate of growth in the share price, in the equity share price, that is required to justify the order of the convertible loan stock, holding on to the security before the option expires? This is 10 marks question. We need to explain this question. What is the
Yes.
expected?
Yes, please.
We need to explain the question. What is the expected minimum annual rate of growth in the equity share price that is required to justify the order of the convertible loan stock to continue to of the convertible loan stock holding on to the security before the option expires? First is, let us remember, convertible loan stock, you have an option to convert it to ordinary shares. As of today, the current price, look at paragraph 4, the last paragraph. The current price of the convertible security is 960. You can decide to sell the convertible bond and collect 960. Now, a bond, you can decide that I want to sell this convertible loan stock. If you are selling today, you are going to realize 960. But you can hold it. You can hold the bond for 2 more years before converting to ordinary shares. Now, if I now want to calculate the expected rates, I will ask myself, I have a choice to collect 960 today, or I will wait for 2 years. I will get interest in year 1, get interest in year 2. Then after year 2, I will exercise my right of conversion. I will convert the debt to ordinary shares. I have a choice between selling the instrument today and getting 960, or hold on to the instrument for 2 years. The option will elapse. This option of conversion will expire in 2 years. That means if I wait for 2 years, I'm going to get interest in year 1. I'm going to get interest in year 2. After year 2, I will convert the debt to equity shares. I will now get the value of the equity shares. Now, to answer this question, we can go to that page. Solution page. All right, we are here now.
Yeah. Okay, I think I'm getting it now. The current price is 3 naira. Okay.
Don't worry. We also
No,
try to explain
I'm trying
in
to
the
wrap
course
my head
of solving
around
the
it before
question.
you start solving so that somebody can understand it better.
Yes. In the course of solving the question, we are going to explain more. You start like this. Current price of the security is 960. Option to hold the security for 2 years. In this case, if you hold it for more 2 years, you are going to get annual interest, which is equal to 100 naira in year 1. Then you are going to get annual interest again, which is equal to 100 naira in year 2. At the end of year 2, you must exercise your right of conversion because you only have 2 years options. At the end of year 2, you must exercise your right of conversion. You now convert the debt to ordinary shares. Look at it. Conversion value. Remember the formula is equal to P bracket 1 plus G raised to power N multiplied by R. The conversion value in 2 years' time. Where your P, your PO, the PO is the current share price. The current share price in the question is 3 naira. Your G is the annual growth rate. This is what the examiner wants us to calculate. Your N, years of conversion. This is 2 years. Then your R, that is the conversion ratio. Examiner says loan stock can be converted to 250 shares. We can refer to it. Let's refer to that. Look at it here, please. Look at paragraph 2. The conversion rate as at 1st January 2016 was 250 equity shares for 1,000 naira of loan stock. That means A loan stock can be converted to 250 shares. That is the conversion rate or conversion ratio. Let's continue. All right. Fabulous. So we can now determine the conversion value. We come here. The conversion value, conversion value is equal to 3 naira bracket 1 plus G unknown raised to power n multiplied by 250. This is equal to 3 naira multiplied by 250. That will give you 750 bracket 1 plus G raised to power n. Our n is 2 years. That will give you the conversion value plus the growth rate. Now, you have a choice between collecting 960 now or collecting 100 naira in year 1, year 2, then also collecting the conversion value. We now equate it. The equation becomes I can get 960 now. And this must equal to, I'm expecting 100 naira in year 1. What is the present value? That becomes 100 divided by 1 plus the discount rate, 0.12 in year 1, plus you are expecting 100 naira in year 2. 100 divided by 1 plus 0.12, that will be in year 2, that present value. Plus, you're also going to get the conversion value in year 2. 750 bracket 1 plus G raised to power 2 divided by, that's not straight, one plus 0.12 divided by raised to power 2. This should be 2, not n. This should be 2. Now let me explain this. Currently, the price of the security is 960. So if I'm going to hold it for 2 years, I will ask myself, what is the cash flow I'm going to get in year 1? What is the cash flow I'm going to get in year 2? I will now discount that cash flow to my present value. If I discount it, it must equal to the value I'm going to get now, which is 960. If it's not equal to 960, then it doesn't worth holding for 2 years. I have a choice between collecting 960 now or waiting for 2 years. Collect 100 in year 1, 100 in year 2, and conversion value in year 2. So I will now discount the future cash flow. If I discount it, it must give me the value I'm supposed to get now. What are we trying to do? We are trying to determine the G. If you are able to get the concept, or I can take it this way again, you have a choice between collecting 1 million now or collecting 1.2 million in 1 year. You now ask yourself, there is time value of money. If I collect 1 million naira now, or collect 1 million naira in 1 year, you now ask yourself, what is the present value of 1.2 million to be collected in 1 year? What is the present value of that money now for me to compare? If the present value is less than 1 million, that means it is better for you to collect 1 million naira now. If you discount 1.2 million to be collected in 1 year to the present value now, and the present value is less than 1 million, that means as a rational investor, it's better to get the 1 million naira now instead of waiting for 1 year to get 1.2 million. That is what we are doing here. The investor has a choice to collect 960 now or wait for 1 year, 2 years. If you wait for 2 years, it's going to get interest in year 1, interest in year 2. Then also in year 2, it's going to convert the debt to equity shares. We now try to discount the future cash flow to the present value, and this must equal to 960. So the question is, what is G? What is the growth rate? We can now estimate the growth rate. Come here, this becomes 960 is equal to 100 divided by 1.12 plus 100 divided by 1.12 raised to power 2 plus 750 bracket 1 plus G raised to power 2 divided by 1.12 raised to power 2. Now apply calculator. Apply your calculator. This is 960. Please, 100 divided by 1.12. What do we have?
89.29. 89.29.
89.29 plus next 100 divided by
79.72.
What do we have?
79.72.
79.72. Then the last one. What we are going to do is simply to say 750 divided by 1.12 raised to power 2.
$597.9.
Okay, that will give us plus 597 point, okay, 0.90
0.9.
approximately, yes, 0.90 bracket 1 plus G raised to power 2. Then your 960 is equal to, we can plus this, it's 9.29 plus 79.72. 89.29 plus 79.72. That will give us 169.01 plus 597.9 into bracket 1 plus G raised to power 2. What next? We can collect light arms. 960 minus 169.01 is equal to 597.9 bracket 1 plus G raised to power 2. Then we can get that 960 minus 169.01. What do we have, please? This will give us
790.99.
790.99
is equal to 597.9 bracket 1 plus G raised to power 2. Then we can make 1 plus G subject of the formula. That is 1 plus G raised to power 2 is equal to 790.99 divided by, this is not straight, $597.9. Please divide. Please divide. What do we have? 1 plus G raised to power 2 is equal to 1.32
23.
to, okay, 23 approximately. Then we have square here. We can move square here, that becomes square roots. That means 1 plus G is equal to the square root of 1.323. Let's get the square root.
$1.150.
1 plus G is equal to 1.150. Then your G is equal to 1.150 minus 1. Your G is equal to 0.11. Your G is equal to 0.151. 150. Convert this to percentage, multiply by 100. Our G is equal to 0.15 multiplied by 100. That will give us 15%.
15%.
Is that not, please? That means the minimum expected growth rate, minimum expected growth rates in share price is 15%. This will give you your 10 marks. Something similar was tested in 2023 diets on bond valuation. This is the expected growth rate. Any question, please? Or please, it's very possible that within the classroom, we are not able to get 100% of the explanation. It's not impossible. But the expectation will be to try and go back, to review what we have done, and try to look at similar questions. All right. May God give us a better understanding. Requirement C. What recommendation would you make to the holder of the securities, and why? What would be your advice to the holder of the security? Should the holder dispose the security today? Or should the holder hold the security for 2 years and convert to equity in 2 years' time? Or should the holder hold the security until maturity 10 years' time? What will be your advice or recommendation to the holder?
I think we can start by looking at the different options and the benefit of each
sir.
options. They now compare. Sir, I don't know whether you can hear me.
I'm trying to, but I can't hear you.
I was saying that we can look at there are 3 different alternatives. Then we can look at the benefit of each alternative, then now compare to confirm which one is superior. For instance, in the first year, they said if they want to sell, I think they will buy at, the issue was sold to the public at a price of 920, and the current price of the convertible security is 960. So we
So you
know
can
that
sell
if
for
you are selling
960.
960, so if it's immediate, the gain is just that 40 naira for the immediate one. Then we can now go to the 2 years convertible option. Then we'll look at the full tenor.
Okay. What I pick for on what Nusa is saying is that since the order has three alternatives, we need to look at the benefits. We need to compare the benefits of the three alternatives now. The first alternative is that the order can decide to dispose the security now and collect 960. In that case, the order will be making a profit of 40 naira because the issue price was 920. That means the order paid 920 as at the time the order purchased the bond. Now the price was 960. So the order can get 960 immediately. Alternative 2, the order can decide to hold the bonds for 2 years. After 2 years, the order will convert it to equity shares. This alternative will only be acceptable if the expected growth rate in share price is equal to or higher than 15%. This alternative will only be reasonable if the growth rate in share price is equal to or higher than 15%. But if the growth rate is below 15%, then alternative 2 make no meaning. I hope that point is clear. Alternative 2
Yes.
will only be reasonable if we have a guarantee that the share price of Bobby Brown will grow at the rate of 15% per annum. That is the minimum expected growth rate that was computed in B. Then the third option is if the order failed to convert in 2 years, then the order will have to wait for 10 years. That particular alternative involves a lot of uncertainty. What will happen between now and 10 years cannot be predicted with certainty. So our recommendation will be either alternative 1 or alternative 2.
Excuse me, sir. For that option of 10 years, even if there are uncertainties, but we can't.
Wow, your voice is low this time. The sound is unlike you.
I don't know why it's low. Can you hear me, sir?
Yeah, I can hear you now.
Is it faint?
Yes, please go ahead, don't worry.
Okay, so I was saying that even that 10-year option, even if there are uncertainties, they gave us enough information to calculate it Then after calculating it, then we can now make the comment because they gave us the coupon. So we have coupon to calculate for 10 years. They gave us, we can assume that redemption is at par value at the 10th year. So we can
Yes.
actually calculate the value today based on the cash flows, coupon, and the redemption value. And now start compare with the first and second
That
option.
will
So I'm
give us
wondering why you are dismissing
887
it.
naira. That will give us the price of 887 naira.
Okay, the first one we calculated.
Yes, that was calculated now.
Okay, yes, that is correct, sir. It's correct, yeah.
Yeah, that makes a lot of sense.
So, sir, if that's the case, then I think I would advise the bondholder to wait for 2 years and then convert to equity shares. Because if I apply that 15% on the 960,
Yes,
I don't know.
that advice is dependent on the expected growth rate in share price. Is that clear, ma?
Okay, so are we expected to calculate that now?
We have done that, ma.
Yeah.
Look
And
at
so
it
that's what I'm
now.
saying, that I've already applied that 15% on the 960.
We have completed that. That's
Okay.
the alternative 2. So wait for 2 years, collect interest in year 1, collect interest in year 2, then exercise your right of conversion, convert the debt to equity. If you are converting the debt to equity, your conversion will only make sense to you if the growth rate in the share price is equal to a minimum of 15%.
Okay.
Is that clear, ma?
Yes,
So
sir.
please,
Thank you.
is that the benchmark for all of it or just for this question? The 15%?
No. When you say all of this, I'm confused now. We
So
know we have
let's
3
say,
Please speak.
I mean, in this question, we calculated 15%. So the minimum expected growth rate, is it 15% for any question or just for this question or when you
Oh,
calculate it?
no,
It's
this
for
is
this question.
peculiar to this question now. Another
That's what I'm
question,
saying, sir. I'm talking about the
yes.
15% minimum. If we calculate in another question and it's 20%, are we going to use that 20%?
Okay, if you have another question, the parameters will differ. Then you are going to get your rate. If the rate is now like 12%, that means for that question is 12%.
Okay, sir.
Is that clear, please? So this
Yes, sir.
15% is for this question, Bobby Brown. I hope that point is clear, man.
Yes, sir.
Okay, excuse me, sir.
Yes, no, sir.
So from this now, we can quickly eliminate the third option. We now have 2 options.
They
There's
can
no
quickly do
best.
what?
We can eliminate the third option to hold to maturity, because if you hold to maturity, you get present value of 887. Okay, why option 1, you get 960. Option 2 is contingent on the share price growing by 15%. So there's no right answer here. So I think the answer is now if you Option 1, you get 960. Option 2 is contingent on the share growing by 15%. That is also uncertain because we don't know. So there isn't any perfect answer here. It's between 1 and 2 with explanation. Then the third option, we'll dismiss that one. I think that is how I see this question.
Okay. What I see coming to play again now is you can now do, if I'm going to hold this convertible bond to maturity, what is the yield to maturity? What is the return I'm going to get until maturity? But for that mark, once you explain option 1, option 2, then you also explain option 3. You might not need, it's not a must to compute the yield to maturity. Let me see if I can accommodate a similar question within 45 minutes. Let us see if you can accommodate a similar question. There's a question on this material. Yeah, question number 4. But it's not in your, I'm not sure it's in your study pack. Look at this question. PSC. This question is similar to the question we just saw. It was tested 2023. But I'm not sure it's in that study pack. We can look at this question, please.
It is. It's in the study pack. Yes.
Oh, great. I didn't know. Okay, let's deal with this question. What page, please, on the study pack?
132.
Page 132. Question 3, right?
Question 4.
Question 4. Okay, please, guys, refer to page 132, question 4. Let us look at PSC. Refer to page 132, question 4. Let us look at PSC. I'll read. PSC add 10 million naira, 5% convertible bond in issue. The option to convert into 40 1 naira ordinary shares is open for 1 more year. They must either be converted in 1 year's time or left as ordinary bond until 9 years' time, when they will be redeemed as par. Please note, the option to convert is for 1 year. If you fail to convert the bonds to equity in 1 year's time, then the bond will have to wait for 9 years, when they will be redeemed as par. The current share price of the current share price is 1 naira 50 kobo. Annual growth rate in share price is 15% per annum. The current required return on Okpe's equity is 25%. The business being relatively risky. The current yield on ordinary non-convertible bond in similar companies is 11%. These interest rates are expected to remain constant. Next, PSC adds 100,000 warrants outstanding, each entitling the holder to subscribe for one naira shares at 90 kobo anytime within the next 3 years. The current share price is 50 kobo. The current share price is 57 kobo. The capital growth is expected to be constant at 12% per annum in the future. And the current share price of a warrant is 10 kobo. Requirements A. Calculate the current value of Okpe's convertible as a straight debt, i.e., ignoring the option to convert, and the value if conversion were to take place today. Will you expect the market value of the convertible to be above or below each of these amounts? Why? Let us start with A. Okay, please permit me to create the solution page. I didn't know this question is here. I will have started with this question, sir. Suggested solution. Now, if you look at that requirements A, because it's important to understand question and to understand the requirement. If you go back to that requirement A, you are supposed to answer 3 questions. Requirements A alone, we address 3 questions. Now look at it. Calculate the current value of Okpe's convertible as a straight debt, i.e., ignoring the option to convert. That means you are going to determine the value as a straight debt. That is one. Number 2, the value of the convertible if conversion were to take place today. You need to determine the conversion value. Assuming conversion happens today. Then number 3 to be addressed. Will you expect the market value of the convertible to be above or below each of these amounts? The 2 amounts competed, and why? That means you are going to explain. So that requirement A, you have 3 questions to address. Let's go to it. I only have 30 minutes. So I'll come here. I'll take that as A1. Value of the convertible as a straight debt. I will now try to itemize the futures of the convertible bond. Futures of the convertible bond. 1, maturity. The maturity is 9 years. 2, the coupon rate. The rate is 5%. 3, the face value. The question is silent on the face value. In this case, you can either assume 100 naira or 1,000 naira. For me, I want to assume 100 naira. 3, 4, redemption value of the bond. Redemption value. Examiner says it will be redeemed at par. The par value is 100 naira. Next, determine the expected cash flow for the bond. Come here, working 1. Expected future cash flows. We have annual interest, That is 5% of face value. 5% of 100 naira. That will give me 5 naira. Year 1 to year 9. The bond will mature in 9 years. Redemption value. That's par value at par. That's 100 naira. That will be at maturity, year 9. We now discount this cash flow to their present value. If you check the question, examiner says the yield on non-convertible bond. The yield on non-convertible bond is 11%. Let's refer to that aspect. Look at it, please. The current yield on ordinary non-convertible bond in similar companies is 11%. That is the discount rate for non-convertible bond. That is the discount rate for non-convertible bond. We can now determine the value. Can come here. Value of the convertible bond as a straight debt. Then open your schedule. You have the year, you have the item, you have the cash flow. We have the discount factor at 11%. Then the present value. We have year 1 to 9, annual interest. This is 5 naira. Please let me compute. Annuity factor, year 1 to 9, at 11%. We have year 9 only, redemption value. This is 100. Please, let's compute. Annuity factor, year 1 to 9. That's
5.54.
5 points.
5.537. 5.537.
537.
5.537. Thank you. Then discount factor year 10 only. Year 9 only, sorry. 11% year 9 only.
0.391.
0.391. Let's multiply. 5 multiplied by 5.537. That will give you 27.69 approximately. Then this will give you 31.10. Please sum up. 79 points. Oh, this is 39 now. Please sum up.
66.79. 66.79.
66.79. This is the value of the convertible straight debt. That is, if the convertible bond is not converted to ordinary shares, its value as at today will worth 66 naira 79 kobo. That is A1. Then part of the question says A2. The value, if conversion were to take place today, the value of the convertible bond, if conversion were to take place today, if you look at the question, a bond can be converted to 40 shares. Is that not? This is equal to a bond can be converted to 40 shares. Now check the question. What is the price per share as of today? Please look at the question. What is the price per share? 1 naira 60 kobo. So you can convert a bond to 40 shares. And price per share is 1 naira 60 kobo. Multiply by price per share. 1 naira 60 kobo. 40 multiplied by 1.6. That would be 64 naira. If the conversion should take place, the value of the conversion value is equal to 64 naira. If the conversion was to happen today, the conversion value will worth 64 naira as of today. Then the other aspect of the question, will you expect the market price of the convertible to be above or below each of these two amounts, and why? I want to check if the answer is here. Yes, it's here. Please look at the expected response to that aspect of A. The question was, will you expect the market price of the convertible to be higher than to be above or below each of these amounts? You know, we computed value as a straight debt. We also determine the equity value as of today. Now the response will be the market value of the convertible is expected to be higher than both its value as a debt and its value and its equity value, because of the option to convert to equity. The reason is that we said the market value of the convertible is expected to be higher than the value as a debt and the value as an equity. This is because of the option to convert. The essence of the market value of the convertible over the straight debt value is the direct value of the option to convert. What we are saying is the market value of the convertible bond will be higher because of the opportunity given to the holder. The holder is given the opportunity to convert the debt to equity shares and take advantage of the company's equity. Because of the option to convert, then the investor will pay for that opportunity. You are given an opportunity to take advantage of the company's equity. Continuation. The reason for the market value exceeding the conversion value is that the holder have the debt to fall back on if the share price drop. What we are saying is the holder is given opportunity. If the share price, if there's fall in share price, then you don't need to convert your debt to equity. You just fall back. You retain your debt value. But if the share price will rise, then you can take advantage of the share price. The reasons for the market value exceeding the conversion value is that the holder has the debt to fall back on if the share price drops. They do not necessarily have to convert. The debt value here has at a floor price. That means it provides a minimum price for the security, which means an investor faces less risk than by simply investing in share directly. If you invest in convertible bond, as an investor, your risk is lesser because your debt value is guaranteed. If the equity share price fluctuates, you can maintain your debt value. That will be the expected explanation for that requirement A.
Sorry, why this answer is a little bit confusing. The explanation is, I don't know why this. I said why the response is a little bit confusing, right? The explanation is okay.
Please identify the area of confusion.
No, because they are saying, the question says, do you expect the market value to be higher or lower? Okay. So in reality, the market value could be lower. It actually could be lower, in which case you will not exercise, the market value could be lower, really. So the answer is like the expectation should be higher, yes, but can it be lower? It could be lower. So that is just that is the part that
Okay, let me quickly correct that. The market value will not be lower. Otherwise, the company issuing it will be shooting itself on the neck. Imagine it's your company. You want to issue convertible bond. Imagine this is your company. You want to issue convertible bond. Before you issue that, you are going to put a price to the convertible bond. Before you issue that instrument to the public, you are going to state a price for your convertible bond. Before you state that price, you are going to ask yourself, what is the price of this bond as a debt? Before you put a price, that's okay. What is the price of this bond as a debt? And that's okay. The price as a debt is 66 naira. If I take this as a debt without putting equity to it, it's worth 66 naira 79 kobo. That's okay. If I now issue my convertible bond, I'm giving the opportunity to the investor to take advantage of my equity. Now the question is, are you going to issue at a price below 66 naira? You are the issuer. Yes, Musa.
yeah.
Will you issue your bond, your convertible bond, at a price below 66 naira 97 kobo?
No.
I can't hear you. But if you do that,
I said no. No.
It's not possible. The company issuing the convertible bond is also an expert. They have hired experts. They will tell us, wait, if you issue this as a debt only, it's worth 66 naira 79 kobo. 79 kobo. If you now want to issue convertible bond, that means we are giving the investor opportunity of our equity. That opportunity, the investor needs to pay for the opportunity. So we must give a price that is above 66 naira 79 kobo. So regardless of the explanation here, you can put it in your own word. Once you understand the concept.
Okay. I get it now. I get it. I get it now.
So
Yeah.
once you understand the concept, this wording is, the major thing is to understand the concepts I'm explaining to the examiner. I only have like 10 minutes, but let's see question 2. Requirement B. Now look at requirement B. By how much should the share price of Okpe PSC rise before orders will be induced to convert on the possible date of conversion? By how much should the share price of Okpe PSC rise before orders will be induced to convert on the possible date of conversion? The first question is, what is the possible date of conversion? That is 1 year's time.
1 year.
Good. I have a choice to convert the debt to equity in 1 year's time. I will now ask myself, What is the value of the debt in 1 year's time? That is, in 1 year's time, I want to know the value of the convertible bond as a straight debt. Because it's an option. I have an option to convert to equity or to maintain it as a debt. So in 1 year's time, look how we are saying, as of today, the value of the convertible as a straight debt is 66 naira 79 kobo. As of today, the value of the convertible as a straight debt is 66 naira 97. Look at it. This is the value as of today. Please stop. This is the value of the convertible as a straight debt. As of today, it's 66 naira 79 kobo. If I now say, okay, possible date of conversion 1 year's time, and I say, okay, what is the value of the convertible bond as a debt in 1 year's time? If I'm now saying 1 year's time, that means as of today, the bond has 9 years maturity. As of today, the bond has 9 years of maturity. That means in 1 year's time, the maturity will have reduced to 8 years. Is that not, please? Hello?
Yes.
In 1 year's time, the maturity of the bond will have reduced to 8 years. So the first thing to do is value of the convertible bond as a straight debt in 1 year's time. The first thing to do here is to say value of the convertible bond as a straight debt in 1 year's time. If I come here, B, the first thing, value of the convertible as a straight debt in 1 year's time is, just come here, your year, 1 to 8 years, then your item, annual interest, the cash flow, this will be 5 naira, it won't change. Your discount factor at 11%. Please help me compute. Annuity factor, year 1 to 8 at 11%. Then redemption value, 8 year, that is 100. Yes, any answer?
5.146.
5.146. Then discount factor, year 8 at 11%.
$0.4339.
434. We can multiply this will give me 43.40. Please get the value. $69.13. This is the value of the debt value of the convertible as a straight debt in 1 year's time. That means for me to be motivated to convert my debt to equity. Hello, let me repeat that. The value of the convertible as a straight debt in 1 year's time is 69 naira 13 kobo. As a bondholder, for me to be motivated to convert the debt to equity, that equity must offer me a value that is equal to or greater than 96 naira 13 kobo. Does that make sense to us? Does that make sense to us? I'll repeat that. In 1 year's time, you have a choice to maintain your investment as a debt. If you maintain the investment as a debt, the value was 59 naira 13 kobo. Alternatively, you can convert the debt to equity. For you to be motivated or to be in deals to convert the debt to equity, the equity must offer you a value that is equal to or greater than 69 naira 13 kobo. Does that make sense to us?
Yes.
Yes, sir.
Please, you must try to find a way, or better still, God will give us a better understanding. You now come here and say, okay, conversion value in 1 year's time. Look at it. Look at it, please. Conversion value in 1 year's time. I'm going to convert a debt to 40 shares. Multiply by the expected share price. Expected share price in 1 year's time. This must give me a value equal to at least 69 naira 13 kobo. For me to be motivated to convert the debt to equity, the expected share price multiplied by the number of shares must give me a value that is equal to 69 naira 13 kobo. What is the expected share price in 1 year's time? The expected share price in 1 year's time becomes expected share price is equal to 69.13 divided by 40 shares. What do you have, please? 1.728. That means in 1 year's time, the share price should be 1.728. For me to be motivated to convert my shares to convert the debt to ordinary shares. Examiner says, by how much would the share price rise? We can determine that now. Please look at it because of time. Expected share price $1.728, current share price $1.600, rise in share price, rise in share price differences 0.128. The share price must rise by at least 0.128. The share price must rise. That is by how much? The share price must rise by the share price must rise by 0.128 for the order to be indeed to convert the bond to equity, to be induced to convert the bond to equity in 1 year's time. This is the expected response. That is the expected response. Oh. Requirement C is theory, but we can explain that. Examiner says, explain why the market value of a convertible bond is likely to be affected by the dividend policy of the issuing company. Remember convertible bond. Convertible bonds contain elements of debt and equity shares. And definitely, dividend policy will affect the price of equity shares. Dividend policy of a company has impact on the price of equity. That means indirectly, dividend policy will affect market value of convertible. You can look at the explanation. Look at the explanation. It's available here. Yeah, look at it. The company's dividend policy has a major impact on its share price and hence on the perceived value of the convertible bond. Assuming for the moment that the company is reasonably profitable, that is, if the company is profitable, any profits not declared as dividends will be reinvested in the business and plugged back into the business. By reinvesting your profits, the more profit will be achieved. By reinvesting your profits, by retaining and reinvesting your profit, the company will make more profits at future periods. All things being equal, the share price will rise. Alternatively, were the company to distribute all its profits, that is, if the company distributes all its profit as dividends, if you are not retaining part of your profit, the share price is likely to stagnate, remain stagnant. If a company is paying out all its profit as dividends, then there's no reinvestment. If there's no reinvestment, there will be no growth. The share price will remain stagnant. By definition, dividends and retention benefit shareholders, whereas by definition, dividends and retention benefit the shareholder, but only retention policy benefits the convertible loan stock, the convertible bond holders. What we are saying is the more retention, the higher the profit to be achieved, and the higher the growth in share price. Payment of dividend is expected to reduce the market value of convertible bond. Please, let us take along with us this explanation of relationship between dividend policy and market price of convertible bond. I'll stop here. We stop the class here. The D part is on share warrants. Maybe when I get to I'm not sure, but warrant is also part of instruments. We call it share warrant, bond with share warrant. I need to explain that concept. What is warrant? What is the impact of warrant on share price? So that might take time, and it will not be fair to be keeping us too long. So let's stop the class here. The little we have explained, may God give us a better understanding. Please, guys, this exam calls for sacrifices. It is not sufficient to be in the classroom. You must create time to review your material. Any question, please? I will be checking out of the classroom.
Just the
If there's no question,
is the calculation of that. Okay, I'll call you, sir.
Okay, you can say it. Let me hear.
Is the calculation the 1 to 8 years, right? Well, we're calculating the value of the convertible bond as a straight debt in 1 year's time. So we use the period of 1 to 8 years, because if you take out 1 year from that, so what I thought it would be 2 to 9 years. It will still be 8 years, but it will be year 2 to year 9. That will now affect the present value slightly. So that's what I thought. So I'll just try and study what was done.
No. Don't create complexity for yourself. You know, when you say in a year's time, that means the bond has 8 years to maturity. Is that not? So it has nothing to do with year 2 to year 9. We only know that that bond has 8 years. Is that clear, sir?
Yeah.
In 2 years' time, the maturity reduced to 7 years. So if you want to calculate the price in 2 years' time, you are going to look at the price for 7 years. So please do not create complexity again for yourself. All right, good night.